I had a question on drawing up the liquidation account and shareholders distribution account in a question which was not purely a liquidation or insolvency question, but actually a business combination question where the company that was being acquired subsequently was liquidated. So if you want to refer to question 1015, it's part B of the required that I'll be covering in this video clip. In this question, we were told that Taylor Limited negotiated to acquire the operations of Flathead Limited, and subsequently Flathead will be liquidated. So part B of the required asks us to prepare the liquidation account and shareholders distribution account for Flathead. Now let's first have a look at the liquidation account. In the liquidation account, we basically record the proceedings of the liquidation process apart from the distribution to the shareholders and the actual cash flows of the liquidation. So I've summarized here some of the entries in the liquidation account. So we normally start off the process by closing off our general ledger accounts with regards to our assets by crediting our assets and debiting our liquidation account. So we transfer the carrying amount of all the assets sold to the liquidation account. By the time that we wrap up the liquidation, we would like to see that all the general ledger accounts have been closed off. So this is the first step. Normally that ties into that is the recording of the proceeds from realizing these assets. Now sometimes the proceeds can consist of assets that are actually sold on an individual basis, whereas in this example the proceeds will be the consideration that was transferred for the acquisition of the operations. The following phase is to record any unrecorded liabilities. Now the settlement of the liabilities will be dealt with in the cash account or the statement of cash payments and receipts of the liquidator. But before the actual liabilities can be settled, any liabilities that have not yet been recorded in the accounting records of the company that's being liquidated needs to be raised. So we do this by debiting the liquidation account, crediting the liability to bring it into the accounts. Another part of the process is to close off the reserve accounts and other equity accounts apart from the share capital account in the general ledger. So typically this would be a credit entry to the liquidation account because these reserve and equity accounts traditionally sit with a credit balance. So by closing it off, we will debit the reserve account, credit the liquidation. The only difference will probably be if we sit with an accumulated loss, in which case that would be a debit balance in our equity section. So we'll credit the accumulated loss and debit liquidation. By the time that we've closed off the asset accounts, recorded any unrecorded liabilities, closed off the reserve and other equity accounts, and recorded the proceeds from realizing any assets, we can then calculate whether we have a surplus as a result of the liquidation or whether there's a deficit on liquidation which has to be borne by the shareholders. So if the balancing figure sits on the debit side of the liquidation account, it means that it's a surplus on liquidation, and that's going to be transferred to the shareholders distribution account. A credit entry to the liquidation account means that there's a deficit on liquidation, so it's going to reduce what will be distributed to the shareholders, so therefore a debit to the shareholders distribution account. Okay, so this basically summarizes just the liquidation account. Let's have a look at the question now, the scenario for question 1015, to see what information is included and how we use that. If we look at the trial balance of Flathead Limited, we first of all see the assets that are currently recorded in the accounting records. Now, cash is normally excluded from the assets that are written off to the liquidation account because the cash is transferred to the cash distribution account or the liquidator's statement of receipts and payments. So we expect to see an entry in the liquidation account for accounts receivable, inventory, shares in listed company. So although I know now in this question that is dealt with separately. Then land and buildings, plant and equipment, and goodwill. So all the assets the carrying amounts has to be transferred to the liquidation account. In terms of the liabilities, these liabilities will probably be covered by the payment arrangement with Taylor Limited. So we'll expect Taylor Limited to provide some cash to be able to settle these liabilities. The share capital is transferred to the shareholders distribution account because that is the account where we summarize the dealings with the shareholders to see whether how much of their investment that will be returned to them. And the other reserves and retained earnings needs to be transferred to the liquidation account as well as part of the process of closing of the general ledger accounts. If we read a bit further, we get information about the arrangement with regards to the acquisition and the subsequent liquidation. So Taylor Limited is to acquire all assets except cash and shares in listed companies. The reason being that the cash is used in settling the liabilities of the company, and the shares listed, we'll see further arrangement regarding that. Here they've acquisition related costs of 7,600. That is for the account of Taylor Limited, so that doesn't affect our liquidation process. Then the net assets are recorded at fair value except for the following. Now these fair values are more important for the acquiring company because they acquire the assets and the liabilities at fair value. That is what the accounting standards state. So the inventory and the land and buildings, it's not going to affect the values that we use in the liquidation, but it's going to have an effect on the consideration, the calculation of the consideration transferred, albeit not a direct effect. Shares in the listed company, once again, just from reading through the question, I know that we'll have to return to the fair value. But then interesting, if we just look at these two liabilities that are listed here, our accounts payable is currently included at a balance of 40,000 in the trial balance. But when we look at what needs to be settled, we'll have to settle the fair value because that's the value that they've calculated is due to our creditors on the date of the business combination. So there's a figure of 9,100 that can be seen as unrecorded liabilities, and that needs to be raised through the liquidation account. Then the accrued leave, that is a obligation of the company, and it has not been recorded in the accounting records yet, so therefore that's also unrecorded liability that needs to be raised through the liquidation account. Okay, this last paragraph then gives us information on the consideration transferred. So I'm not going to have a look at that at the moment. I first of all want to look at the liquidation account entries. The information in this last paragraph, as well as what's included on the following page of the question, gives us sufficient information to calculate the consideration transferred in the acquisition analysis. Now, I'm not going to go through that calculation at the moment, but the total of this 252,300, that's the proceeds part to the liquidation account. So let's look at the liquidation account. So as you can see in the liquidation account, first of all, we deal with the transfer of the carrying amount of the assets that were sold, excluding the cash and the shares, the listed shares. And you can trace this straight back to the trial balance and the values included in the trial balance. The second part is then to record the proceeds on selling the business, basically, and that is equivalent to the consideration transferred. We then continue to record any unrecorded liabilities. Now, if you recall from the question, there was a figure of 9,100 for the accounts payable to bring the recorded amount to what actually had to be paid in terms of the liquidation process, which is represented by the fair value of the accounts payable. The accrued leave payable, that creditor was not recorded in the accounting records, and it is an obligation of the company, so therefore we have to record that liability on liquidation. And then the liquidation costs payable, it's also a creditor that needs to be raised. If you can just remember that from your studies, that this is one of the first creditors that will be settled. Looking on the credit side now, the next step is to record the transfer of retained earnings and other reserves. So all your equity balance apart from share capital, because share capital is included in our shareholders distribution account where we deal with our distribution to the shareholders. We also have to deal with the shares in the listed companies, where the question stated that the shares in the listed company would have been sold and the proceeds would have been distributed to the shareholders' distribution. Now, this was sold together with the shares in the listed company that was owned by Taylor, and that was transferred to Flathead as part of the consideration transferred. Now, the shares that was recorded in Flathead Limited, the shares in listed companies, was recorded at $22,000. It was realized at $18,000, which is the fair value carrying amount. So therefore you can see that they've suffered a loss of $4,000 on this asset, and that has to be recorded in our liquidation account because that affects what is available for distribution to the shareholders. Now, this is done separately from the other assets, the reason being just that it's realized separately, where these assets were basically sold as a unit to Taylor when they purchased the operations of the company. So at this stage we can then square up the liquidation account, and we see that we've sit with a debit balance that will go to our shareholders distribution account. It actually implies that there's a surplus on liquidation because that is going to increase what the shareholders were going to receive. Okay, so the shareholders hoped that they would receive their initial investment of $150,000. However, they're going to get more. They're going to get a further $8,000, the surplus on liquidation. How's that settled to the shareholders? Well, first of all, the cash from the selling the shares in the listed companies, which consist of the 18,000, which was the fair value of the shares owned by Flathead, plus the 15,000 of the shares in the listed companies that were previously owned by Taylor and transferred to Flathead as part of the consideration transferred. So that is the cash that is distributed to the shareholders. Apart from that, they're also going to get shares in the parent company. So the shares in the parent company and the 15,000 that shares in listed companies that were transferred by the Taylor to Flathead, that forms one part of the consideration that was transferred to Flathead for the acquisition of the operations, the assets, and of Flathead. The other part of the consideration transferred relates to the cash that was given, a cash amount that was sufficient to settle the liabilities, and that of course is dealt with in the liquidator's cash account, not in one of these two accounts. I trust this discussion has clarified how the liquidation account was drawn up in this question. If you have any further questions, you're more than welcome to send a message through, to which I'll be able to respond.